My name's Stephen Barbridge. I'm a research manager at NAB Asset Management, and today I'm joined by Richard Dixon, the portfolio manager for the High Growth Shares Fund. Thanks for your time today, Richard.
Thanks, Stephen.
Richard, can you tell us a little bit about the fund?
Yeah, the Antares High Growth Shares Fund is a long-short Australian equities fund that aims to significantly outperform the market over the medium to long term by employing three key strategies. So, short selling up to 25% of the value of the fund, reinvesting those into what we call enhanced long positions or larger overweight positions into stocks that we like, and then active trading is the third strategy. The fund has a very long track record over spanning nearly 2 decades. I've been the lead manager for around 12 years and been on the fund for about 17, so a large proportion of the time of the fund, and the track record is very strong, achieving an investment of 100,000 in the fund back in December 99 at inception would be worth 700,000 after all fees, and versus the benchmark over that same time period, the ASX ASX 200 accumulation index of about a bit over 400,000. So very significant outperformance over a long period. We employ primarily a bottom-up research process, and what we say is style agnostic, so we're not wedded to either just value or just growth stocks, and we're really aiming to provide consistent performance and outperforming different market conditions.
Given the bottom-up research process, how have you kind of seen the recent surge in volatility in markets?
Yes, well, after a very stable period really, and through much of 2017 in particular, we saw, I guess, a virtually synchronised global growth, which was very conducive to markets sort of steadily rising, and extremely low volatility, almost lowest on record. And that changed quite dramatically as we earlier this year, so early February. There was a couple of catalysts for that sort of broke the complacency that markets had. We saw some stronger than expected wages growth, which fueled some inflation concerns in the US, and fears that interest rates would be needed to increase quicker than previously expected. We also saw a bit of a worrying trend towards, I guess, trade wars between particularly the US and China, and certain industries like steel and aluminium, where there was a tit for tat between the US and China over trade wars, which sort of derailed things a bit and really took a knock to the market. So we saw a bit of weakness. The market corrected quite hard. We sort of view those periods as good opportunities, particularly for an actively managed long-short fund such as ours. We have a lot of levers and tools at our disposal to outperform in different conditions, and we took advantage of some of those opportunities through that period. So despite all the uncertainty, we saw earnings both in the US and in Australia, remain quite robust and quite intact. So we viewed it as some good opportunities for the fund. Yeah,
and following on from that, with the recently concluded reporting season, what kind of changes or what kind of portfolio activity has been happening?
Yes, well, it was another quite strong reporting season in Australia in February, and then followed on more recently with the US reporting season has been quite strong as well. Both countries have seen a lot more stocks beat expectations than miss expectations. And certainly in Australia, a feature has been very robust balance sheets as well, which has led to capital management, so buybacks, higher dividends and the like, which has underpinned some markets to a degree, and has really helped seen markets recover quite strongly from that weakness in February that was more macro factors, and as they're focused more on the bottom-up fundamentals, which are quite sound, we've seen markets recover quite strongly through March and April. So that was some of the key themes. There were obviously higher energy costs in particular were a bit of a headwind for some industries. So particularly those, I guess, energy intensive companies. So whether it's building, construction, some mining, that big users of energy were a bit impacted, and manufacturers and the like. So that was a notable headwind. But yeah, generally it was a pretty good reporting season again, and pleasingly on the fund. We had our probably 4th or 5th strong reporting season in a row over the last sort of couple of years, and really that was, I guess, being well positioned in a few stocks that beat expectations. So some enhanced long positions that we had in stocks like Computershare, Qantas, CSL and ResMed were some that come to mind, that all beat expectations and delivered strong alpha to the fund. So yeah, it was a pleasing period for us.
Thank you, Richard. That's been a great recap of certainly the fund and the market, and I appreciate your time today.
Thanks for your time.